Okay, so that's the second reason why, given by the Commission as to why we might want to raise further revenue from the financial sector. The third reason is to create a new revenue stream for the EU. So when the proposal was made in September of last year, the Commission wasn't clear as to how the funds would be used, how they would be split. Since then, last March, the Commission issued a paper whereby it said that the revenues would be split in the following way. 2/3 would go to the Commission, to the EU, towards the EU's budget, and 1/3 would go towards the budget, towards the member states. And the idea is that this would reduce the national contributions. Now, the way this is done leads to some interesting geographic redistribution, which I won't go into, but I'm happy to discuss later. Actually, I'm happy to discuss anything I speak about later. Okay, so that's the objective. Is the FTT the best instrument to achieve this objective? And I think, again, the answer is no, for a number of reasons. First of all, if you want a source of funding for the EU, you really want to find a stable and secure source. Now, the tax base of the FTT is both volatile and there's a certain amount of uncertainty surrounding it. So for that reason, it doesn't look like the ideal candidate. More importantly, I think there is no, at least I haven't heard a good argument, a cogent argument articulated as to why the financial sector should finance the EU's budget more than other sectors. Okay, so those were the three reasons given by the Commission as to why we might want to raise further revenue from the financial sector. And actually there's a fourth reason, which the Commission doesn't go into, which I think is the, so I think this is one of the better reasons why we might want to impose a tax on the financial sector. And this is to compensate for the implicit state guarantee. So this is the too big to fail problem, which has already been mentioned. We know that some banks are too big to fail. We know that because of the systemic consequences that would result from their failure, states will never allow them to fail. Because the markets know about this too big to fail issue, and the banks enjoy an implicit guarantee. Because of this implicit guarantee, they can obtain funding on cheaper terms. That means a lower cost of capital. A lower cost of capital leads to excessive profits. And there actually are estimates of the value of this guarantee. There's one, I put here a reference to the one by Andy Haldane from the Bank of England in 2010. Okay, so we know about this guarantee. We know that steps have been taken to reduce it. For example, in the UK, there's been the introduction of the special resolution regime for banks. There have also been proposals by Sir John Vickers for ring fencing and for loss-absorbing capital. And I think it's, of course, one can't argue. It's a good thing that we take steps to reduce this guarantee. However, this guarantee can only be reduced. It can never be eliminated. And because because it cannot be eliminated, and because banks do not pay for this guarantee, that I think is a good argument as to why we might want to impose a new tax on them. Okay, so I think this is one of the better arguments to impose a tax on the financial sector, at least part of it. Okay, so that's the objective. Is the FTT the best instrument to obtain this objective? And the answer is no, because the FTT targets financial institutions whether or not they enjoy the guarantee, and we know that not all institutions enjoy the guarantee. A better option would be a bank levy, such as the one which has been adopted by the UK. And this is the case because the bank levy only targets a certain number of banks. It only targets the banks which enjoy the guarantee or which are more likely to enjoy this guarantee. And actually, the levy increases, the amount of tax paid under the levy increases with the probability that the bank will be saved by the state, because it increases with the riskiness of the bank. Or actually with one measure of the riskiness of the bank, because it only looks at the liability side, not the asset side. Okay, so those were the reasons given by the Commission as to why we might want to raise further revenue from the financial sector. Now, there are other three considerations which one could make on the FTT as a revenue raiser, independently of the reason why we would want to raise revenue from the sector. Now, I've been told I have a bit less time than's on the program, so I won't go into these. Essentially, the 3 points are the following. The first one is that the FTT is susceptible to avoidance through relocation in a way that other taxes aren't. The second point is that the tax appears to be more distortionary and therefore less efficient than other taxes. And the third point is that, the point which I mentioned earlier, is that the incidence of the tax is more likely to fall on the consumers than other taxes. Actually, since I think you're probably all quite interested in this issue of relocation, I'll just point to one. So the Commission recognizes there's this danger of relocation of activities with the introduction of the tax. All I'll point you to is this quote taken from the impact assessment about OTC derivatives. And it says, the application of the tax in this highly mobile market will be difficult and reduce the taxable base significantly. The tax base could largely disappear, leaving no substantial revenue. So the Commission recognizes this danger. And actually, okay, so I'm speaking a bit more than I thought I should, but so actually the Commission seems to adopt a double standard here. When it's arguing about the need to ensure that the tax is introduced at an EU-wide level, it puts forward this argument. It says we can't have a few member states adopting the tax and not others because activity will relocate to the member states that don't adopt the tax. If this argument applies within Europe, it certainly applies for beyond Europe too. Okay. So I'll go through the three other objectives much more quickly, as I said. Okay, so the second objective for the FTT is the following. It's to create disincentives for transactions that do not enhance the efficiency of financial markets, thereby complementing regulatory measures aimed at avoiding future crises. So the argument here is that there are these transactions which are somehow harmful to the market, and the Commission seems to have in mind in particular short-term trading and high-frequency trading. The FTT will reduce this kind of trading, and by doing so, it will reduce the probability of a crisis. And I mean, that's obviously a very powerful argument at a time when we're all suffering the consequences of a previous crisis. Okay, so that's the argument. There are these transactions which are harmful, and the tax will reduce or even eliminate these harmful transactions. However, when we look at the impact assessment, we find the following. The empirical economic literature is still rather inconclusive on the effects from this trading form in terms of increased volatility or price deviations. In its consultation document on MiFID, the Commission states the following. Existing evidence is inconclusive about the impact on high-frequency trading on market efficiency. In fact, there are some studies which suggest that the high-frequency trading could have a negative effect on market efficiency. However, some studies find the opposite results. They suggest that high-frequency trading has added to liquidity, has reduced volatility, and has helped align prices across markets. So my point here isn't that the studies which find that high-frequency trading has these positive benefits are better than the studies which have found the opposite effect. All I'm saying is that, as the Commission itself recognized, the question is an empirical one, and currently the empirical literature is inconclusive. Okay, putting that to one side, let's assume that we are convinced that the empirical literature were to show that high-frequency trading was harmful. Would the FTT be the instrument which is best suited to address this objective? And the answer is no, because the FTT, even if we knew which transactions were bad, the FTT can't distinguish between a bad transaction and a good transaction. A better way of dealing with any issue there are with high-frequency trading, and of course there are some issues, as the flash crash of 2010 showed us. There are issues, but a better way of dealing with it is through regulation. And in fact, there is regulation at an EU-wide level. ESMA has produced some guidelines, and the Commission also deals with it through the revised MiFID. One final point here is that at times the impression is allowed to spread. The FTT deals with some of the causes of the past crisis. It does nothing of the sort. The FTT doesn't deal with excessive leverage. It doesn't deal with insufficient liquidity coverage. Actually, these issues are targeted by a bank levy. They're not targeted by the FTT. Okay, last two objectives. The first one is to avoid the fragmentation of the internal market. And I'll quote, the proposal says the FTT is also needed, and I quote, to avoid fragmentation in the internal market for financial services, bearing in mind the increasing number of uncoordinated national tax measures being put in place. So when you read this, you get the impression that there are FTTs sprouting all over Europe and there's a need to coordinate them. It's true, there have been taxes on the financial sector sprouting all over Europe, but they're bank levies, they're not FTTs. So if the Commission was really concerned about these bank levies sprouting all over Europe in an uncoordinated fashion, it should have introduced legislation for an EU-wide bank levy. Final point, the final objective of the proposal is that of paving the way towards a global introduction of the tax. So the proposal argues, the present proposal demonstrates how an effective FTT can be designed and implemented, generating significant revenue. This should pave the way towards a coordinated approach with the most relevant international partners. So the idea is, if the EU goes ahead and introduces this tax, it will somehow encourage other states to follow suit. Now, of course, you can believe this, but it seems to me to be heroically optimistic. We know that some states are clearly against it, including the US, Australia, and Canada. Whether introducing the tax at an EU level would incentivize places like Hong Kong and Singapore to follow suit, or whether it would give them incentives to move in the exact opposite direction and thus attract business from the EU shores, is something we can discuss. Okay, my conclusions. So I believe some objectives are reasonable. I think there are good reasons to introduce new taxes on the financial sector. I think other objectives are not reasonable. I think they're questionable, at least. Given those objectives, whether they're reasonable or not, I don't think the FTT is the correct instrument to achieve them. So I think the objectives set out by the Commission are better achieved through an FAT, through regulation, and through bank levies. For this reason, I believe Malta's opposition to the proposal appears to be justified. Thank you.